Hello everyone. So in this lesson, I want us to take a look at the rules that we shall be using to make our swing trading entries within this particular trading system. Okay, so let's get started. We did say that the market basically moves in three different directions. We say that it can move to the upside on overall, or it can move to the downside on overall, or it can move sideways, and that is known as consolidation. So if we take a look at this in hindsight, we can say that this market is in an uptrend, okay? And we did say that in order to predict that an uptrend is started, okay, before you know basically what will happen later in the future, you look at the MACD oscillator, okay? Whenever you've got the white line of the MACD oscillator going above the zero line, then basically you can say that an uptrend has started. The MACD basically will be helping us identify the trend in the market, okay? We also say that the MACD oscillator helps us identify retracements within trends, okay? For example, here we do have these MACD histograms falling below the zero line, okay? But then we see that the MACD line, the white line, remains above the zero line. Okay, so it means we are in an uptrend, we are still in an uptrend, but then this phase is a retracement. Okay, so let's take a look at this. In order to identify our trading opportunities, we must first identify exactly where the trend started. Okay, so the trend started right there. Okay, and after we've identified where the trend was shown to have started by our MACD, okay, then the next thing that you are supposed to do is to identify the last swing low before the new trend, okay. So it means we have to look at the last MACD histogram dip below the zero line. So in this case, the last one was this one, okay, and then after that the MACD histograms, they went above the zero line, okay? And then after we've done that, we have to identify where we've got the lowest point within this region where we had our dip, okay? And then we'll notice that our lowest point was right there. Then after that, you wait. And then if you notice that we did have the market change its trend to the upside somewhere there, okay, and then you can see that we had these impulse histograms, okay, impulse move histograms, because they're in the direction of the trend, okay. And then the next thing is we had a decrease in the momentum of the impulse, okay. So during this phase you'll be watching, okay, watching and waiting, watching and waiting, and then when the histograms dip below the zero line, okay, that is when it catches your attention, because it tells you that the retracement has started, okay, it confirms that the retracement has started. And then when this happens, basically what you're supposed to do is you take your Fibonacci retracement tool, and then you click from the lowest point, then you drag it up until you get to the highest point of this impulse move, okay. So this is why it is important that you must first wait until this whole impulse move is finished, okay, so that you're able to know where to plot your Fibonacci, okay. So right after that, we will have to wait until price enters the zone between 50% Fibonacci retracement and 61% Fibonacci retracement, okay. And this zone is known as the golden zone, okay. So you just plot a box there, okay, which is known as your golden zone, and then you can delete your Fibonacci, okay. Then after having that zone, okay, what you have to wait for is the retracement to progress towards that zone, okay. The retracement will be progressing towards that zone, and then finally price enters that zone. And when price enters that zone and encounters a rejection, and then right after this rejection, when you see a bullish histogram, okay, a bullish histogram, remember I said that we shall be using this colored histogram as our trigger, okay. And then when you see this in the uptrend, know that this retracement period may have ended, okay. So you are going to enter your trade right there, okay, at the close of that candlestick, and then you put your stop loss right below the last swing low, okay. And then after putting your stop loss right below that last swing low, you have to calculate a 1:3 risk to reward, and in this case is 1, and then 1, 2, and then 3, okay, which means you'd have been exiting the market right there, okay. So basically this is your buy setup, okay. This is your buy setup. Now let's take a look at another example. Right after this trade, we had another similar situation, okay. The last swing low was this one, okay. So it means we would have started plotting our Fibonacci from this point, okay. And then the market went bullish, okay. And in this case, you'd have been waiting patiently. And then the histogram did dip below the zero line within this uptrend, okay. So in dipping below the zero line, basically, that's when you start drawing your Fibonacci. Draw it all the way to the top there, okay. And then you draw your sweet zone. And then right after drawing your sweet zone, you are waiting for price to enter that sweet zone. So the next thing that you do is you delete your Fibonacci, okay. Then after deleting your Fibonacci, you wait until the market gives you a signal to buy, okay. So it will have given you a bullish signal right at this green histogram there, okay. And then you are buying at that price, okay. Make sure that your stop loss does not exceed 75 pips, okay. So this is swing trading. Make sure that your stop loss does not exceed 75 pips. That is the general rule, okay. And then it must be way below this last low, okay. Or what you can do is, if it is close enough, if you have drawn your Fibonacci level, okay, you look at this level written invalid trade, okay. Make sure that your stop loss is below that level, okay. So in this case, we'll put our stop loss right there. And then right after putting our stop loss, we have to calculate a 1:3 risk to reward. So that's 1, and then 2, and then 3, okay. So it have been exiting our trade somewhere there, okay. Alternatively, what you can do is to exit your trade, you have to look at your MACD oscillator, okay. So as long as these histograms remain green in color, you should not exit your trade, okay. So this can go beyond your initial market target. Okay, then whenever you get this one, the yellow histogram, okay, then it's a signal basically that it's time for you to exit your trade, and you shall do accordingly. Then let's take a look at another example, and then we did have another chance there, and then this was the last swing low, and then this was the impulse move. Okay, so we are drawing our Fibonacci from there all the way up to there. Okay, so we started drawing our Fibonacci from the last swing low, which was this one. Okay, and then we are targeting the high or the highest point of this impulse move. Okay, and then during this impulse move, we are noticing that the retracement starts right here. Okay, we get confirmation that the retracement is started at that point. Okay, so at that point, that is when you draw your Fibonacci. Okay, and right after drawing your Fibonacci, you are supposed to wait until price shows rejection within the switch zone. Okay, so let's delete this. So when price enters that switch zone, okay, you are going to have a bullish histogram from your MACD, okay, acting as your market entry signal. And then you are entering the market right there, and then your stop loss should be somewhere there. Or alternatively, I say that you can use this Fibonacci to give you your stop loss level. Okay, so in this case, it should have been around there. Okay, but you don't have to use it. You can just place it below that last swing low. Okay, just a little bit far off that last swing low. So in this case, let's just say it's that one. Sometimes you have to use some reasoning because this is your entry point. Okay, and if you are to place your stop loss there, it will be too far. But if it is close, then you should do so. Okay, but it is far, so we cannot really do that. Okay, then we delete our Fibonacci, and then the next thing is we have to select our target. So that's 1, 2, 3. So it has been exiting our trade somewhere there. Okay, and in this case, unfortunately, it missed it by a few pips. But then we say that you exit your trade the moment that you get these yellow histograms on the impulse move to the upside. Okay, so the impulse move is this one, and then we've got this yellow histogram right there to tell you that it's time for us to exit the market. It will not go further anymore. Okay, and then this one, I'm sure it produced an invalid trade. So let's look at it. Basically, you'd have had your Fibonacci being plotted from that move, and then you'd have been using this impulse move to determine your high. Okay, and then the market did come there. Okay, and it did show some signs of rejection right there. Okay, but if we notice, our MACD didn't give us anything during that period. Okay, so our MACD would have given us something right there. Okay, and most likely would have taken it, and after taking it, would have lost the trade. Okay, let's take a look at this. You also have this other opportunity. Okay, you can see that it does look like a small move to the upside, but if you take a look at our entry rules, we say that you determine the last swing low. Okay, and this was the last swing low, okay, based on this movement of the histograms to below the zero line. And then we determine the impulse move. The impulse move was this one, and you wait for it to end, okay. So it ended right there, okay, and right there you'd have drawn your Fibonacci, okay. Immediately when this impulse move showed that it has ended, you'd have drawn your Fibonacci, and right after drawing your Fibonacci, you'd have been waiting for another impulse move, and you'd have gotten it right there, okay. Then placing your entry right at that close of this candlestick, and then your stop loss somewhere below it, okay, somewhere there, and then your 1:3 risk to reward 1, then 2, and then 3. So your exit should have been somewhere there. So basically that's it for the buy entry rules, okay. So see you in the next lesson where we shall be looking at the sell entry rules. Bye bye.